Hello and welcome to Livewire Markets. My name's Tom Richardson and today I'm sitting down with Michael Smith, the co-head of Ares Private Credit Group, and we're going to talk all things investing in private credit. Michael, welcome.
Thanks, Tom. Thanks for having me.
Thank you. Okay, a lot of people might have heard about private credit, but they might not be sure what it is. Can you define it for us?
Sure. It's a word often used in the press today, and I think a lot of people are inquiring about it. To me, private credit, private debt is when a borrower comes to a lender for a privately negotiated deal. It could be across a corporate asset, it could be across a financing for a pool of assets. So it can mean many different things in the end markets. It could be infrastructure, it could be real estate. For us, it's a lot of corporate credit, but it's somewhere where the borrower can come instead of going to a bank and work with a differentiated lender.
Okay, it's been a real buzzword, private credit, in Australia the last couple of years. What do you attribute its growth to?
Yeah, sure. I think it's kind of twofold. I think the first fold is the structural environment in the US and Europe with the banking system. There's been a lot of bank consolidation, especially in the US and increasingly so in Europe. That coupled with the regulatory environment, banks being leery of lending to sub-investment grade companies, has created an opportunity for lenders like Ares and other private lenders to come in and fill that void. Secondly, the borrowers are desiring this type of credit. Especially in the middle market where firms like Ares focus. Those borrowers are dynamic businesses. They are looking to do acquisitions, they're looking for capital to grow their business, and so being able to privately negotiate a transaction with a lender like Ares allows them to effectuate their corporate goals in a way that a bank traditionally doesn't let them.
And what are the advantages of private markets versus public markets?
For the borrowers, it's that flexibility. It's able to come there, customize a financing package, able to work with your lender, have them understand what you want to do with the business, and communicate to them, hey, I might need more capital down the road, and would you be willing to provide that? For investors and firms like Ares, we get a premium for providing that customized service. And so as an investor, you would be attracted to the higher yields on private credit because managers like Ares are going out, customizing these packages, and documenting the transactions with the borrowers.
And the returns have been strong historically, but why is today a good time to invest in private credit?
Yeah, we like to say it's always a great time. Right now is a fantastic time to be in the market. Banks can continue to consolidate. The regulatory environment is still such that they are not lending to middle market companies. Even with the banks in business or being active, they are still very much in an underwrite and distribute model, whereas lenders like Ares in the private credit sector are there to underwrite transactions and hold the debt and be your partner. Interest rates are high, the spreads, like I mentioned, are attractive, and so we're pretty regularly able to get somewhere between 9 and 10 yields on our assets, and we pass that on to our investors.
Okay, yeah, Livewire readers really love yield. Do you want to touch a bit more on how you offer income?
Yeah, absolutely. So most of our products that we offer give a quarterly and/or monthly dividend to the investor. So we go out, we find great borrowers who pay that interest to us. We collect it and pass it on to our investors on a quarterly basis, typically.
Okay, and a typical yield is?
Typically, yield is somewhere in that 8 to 10%.
Okay, I think you touched on there are some areas of the market where banks tend to avoid making loans. Can you take us through why you're happy to invest in those areas?
Yeah, I wouldn't say the banks avoid it. I said that their business model over the past 10 years has evolved where they like to underwrite and distribute the risk. That leads to them focusing on companies with an enterprise value of, say, greater than $2 billion, which enables them to underwrite a loan, $1 billion loan, and syndicate that to insurance companies, hedge funds, and asset managers, typically on the loan market. We focus on smaller companies, typically less than 250 million of EBITDA, where we're providing a single tranche credit facility to that company. We often focus on private equity owners of those businesses because they're coming in, they're seeing a business opportunity to grow that business. They want a patient, customized financing package in the middle market for high growth, attractive businesses where they can effectuate change and create value in those companies.
And how do different private credit managers differentiate themselves?
It's a large market, and private credit managers differentiate them, A, by the types of assets that they focus on. Some might be focused on asset-backed, some might be focused on corporate. At Ares, we focus very much on private equity-backed companies. Also, they differentiate themselves by their tenure in the market and their reputation. We've been active in these private credit markets for over 20 years, demonstrated an ability to originate our assets, to manage collateral, to deliver that yield to our investors. We're also part of a large global platform, I think, which differentiates us and some others that are affiliated with these large global managers that deal with regulators and investors across the entire spectrum of the world. And we think that that's a super competitive advantage.
Thanks very much, Michael.
Appreciate it.
If you like that video, please visit livewiremarkets.com and subscribe to our YouTube channel.